markets continues as tariff blows are being thrown between the US and China. In today's report, we are to discuss the recent developments in the ongoing trade wars. We are going to conclude the report with a technical analysis of S&P 500's daily chart for a rounder view. President Trump's Liberation Day occurred last week. The US announced a base of 10% tariff on all imports into the US. The decision by the US has been met with widespread criticism, with the EU seemingly preparing to retaliate against the US, with the EU Foreign Affairs Council releasing a statement in which it is said that ministers also address the possibility of further proportionate countermeasures if needed. Moreover, since the announcement of the additional 34% tariff on China, both nations trading blows back and forth with one another. Starting with China retaliating with a 34% tariff, prompting the US to announce another 50%, which has now led us to today's report, where China announced a further 50% tariff on US goods. Therefore, as things stand, the US has imposed an 104% tariff on Chinese goods, and China has imposed a 84% tariff on US goods. In turn, the ongoing trade wars and the continued escalation of the blows being traded between China and the US may weigh on the US equities markets as the uncertainty surrounding the global economic outlook continues to mount. Our take on the ongoing trade war is that all sides are attempting to garner as much leverage as possible before heading to the negotiation table in order to find an amicable trade deal. It appears that both sides are playing a game of chicken and waiting to see who bows out first. In conclusion, we would not be surprised to see the ongoing trade wars weighing on the US equities markets in the near future until the dust finally settles and the US showcase a clear willingness to go back to the negotiation table to reach an amicable trade deal with its trading partners. The S&P 500 appears to be moving in a downward fashion, marking a dramatic turn of events. We opt for a bearish outlook for the index, and supporting our case is the RSI indicator below our chart, which registers a figure below 20, implying a strong bearish market sentiment. Yet at that figure, it may also imply that the index is oversold and may be due a correction to higher ground. Nonetheless, for our bearish outlook to continue, we would require a break below the 4,835 support level, with the next possible target for the bears being the 4,605 support line. On the flip side, for a sideways bias, we would require the index's price to remain confined between the 4,835 support level and the 5,265 resistance line. Lastly, for a bullish outlook, we would require a clear break above the 5,265 resistance line, with the next possible target for the bulls being the 5,535 resistance level. Those were the top financial stories for this hour. From all of us